Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning, this is Peter Lewis, welcoming you to Money Talk on Wednesday the 12th of August. We're halfway through the week already. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 100 million customers across 13 countries. In today's business and finance headlines, Donald Trump has laid out new terms for Iran, seeking compensation for casualties from conflicts involving Iran over several decades. That comes after Tehran reiterated requests for reparations in talks to wind down the war. Trump and other US officials had recently boosted market optimism by suggesting a deal with Tehran was getting closer, with Iran and Oman in discussions to reopen the waterway to maritime shipping. The latest twist puts the two countries on a new collision course. Brent crude oil hit $90 again before easing to trade 1.4% higher at $88.91 a barrel, and prices are up now more than 46% this year. The Reserve Bank of Australia left interest rates on hold at 4.35% for a second straight meeting yesterday, as expected, in a unanimous decision after back-to-back hikes earlier in 2026. The central bank cited higher unemployment and a weakening property market as reasons for the hold. The Reserve Bank board said it remains focused on ensuring that high inflation doesn't become embedded and will continue to do what it considers necessary to bring inflation sustainably back to target. Singapore has sharply revised upwards its full-year growth outlook after its economy expanded 5.9% in the second quarter, powered by a global surge in artificial intelligence investment that has more than offset the expected drag from the Iran war and energy market volatility. The Ministry of Trade and Industry now expects 2026 GDP growth of 4.5% to 5.5%, more than double its earlier forecast, citing stronger than anticipated demand for semiconductors, data center infrastructure, and other AI-related exports. Nvidia has launched one of the most ambitious financing efforts in tech history, lining up more than $500 billion in potential capital from Wall Street heavyweights to help customers fund the explosive build-out of AI data center infrastructure. The chipmaker signed memorandums of understanding with several firms, including BlackRock and Goldman Sachs, creating dedicated financing platforms that allow hyperscalers, frontier AI labs, and enterprises to borrow against NVIDIA hardware and data center projects, much like traditional infrastructure assets. On today's podcast, I'm joined by Richard Harris, Chief Executive Officer at Port Shelter Investment Management, and Sunil Kashyap, Director of Finmet. With a view from Japan is John Beirne, Principal Economist at the Asian Development Bank. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street Tuesday, US stocks posted small moves. The S&P 500 index lost 0.33%, dropping for a second day and closing at 7,728. The Dow shed 184 points, or 0.33%, to end at 53,792. The Nasdaq Composite fell 0.6% to 26,445. Today's US Consumer Price Index report is the main focus of the week and may offer fresh signals on the path for Federal Reserve interest rates after Friday's softer than expected jobs data tempered bets on an immediate hike. Oil coming off its highs of the session helped slow a rise in government bond yields. Earlier in the day, both the 10-year and 30-year Treasury yields approached their 2026 closing highs. 10-year Treasury yields fell 2 basis points to 4.69% after a 6-point jump on Monday. The yield on the 2-year notes was 2 basis points lower at 4.22%. Currencies had a quiet session, impacted by the holiday for Japanese markets. The US dollar index held steady just below 100. The Japanese yen was unchanged at 159.3 yen per dollar. The offshore Chinese yuan held at 6.75 renminbi per dollar. Gold pulled back 0.5% to $4,367 an ounce after climbing above $4,400 earlier in the session. And Bitcoin is trading at $63,600, down 0.8% over the past 24 hours. Sentiment towards the technology sector remained buoyant in Asia, with South Korean stocks rising on news that Samsung is considering a massive shareholder return package. The Kospi index climbed 0.7% to 6,346, but that still leaves it over 30% below June's record high. Samsung Electronics gained 4.1%. Japanese markets were closed for a public holiday yesterday. In Hong Kong, the Hang Seng Index closed down 285 points, or 1.1%, at 25,653. And the mainland CSI 300 was down 0.8% at 4,664. Looks like it's going to be a mixed start for Asian markets, according to futures markets across the region. In Hong Kong, the Hang Seng projected to start the day down 0.33%. Looks like the Nikkei 225 in Japan is going to open up 0.2%. And you can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Much to talk about there, so we have our Wednesday morning analysts with us. Richard Harris, Chief Executive Officer at Port Shelter Investment Management up in Hong Kong, is here. Morning, Richard.
Good morning to you, Peter.
And also joining us from Hong Kong is Sunil Kashyap, who is Director of Finmet. Morning to you, Sunil.
Good morning, Peter.
Now, as you heard there in the headlines, Donald Trump has substantially escalated his demands on Iran as negotiations to reopen the Strait of Hormuz have stalled. He insists Iran must pay reparations for past attacks and also be held responsible for deaths linked to Iran-backed groups across the Middle East. Trump said also the US Navy now has 100% control of the strait after clearing mines and maintaining a months-long blockade of Iranian ports. Iran, however, continues to insist the waterway will remain closed until the US lifts its blockade, withdraws regional forces, releases frozen assets, and compensates Tehran for war damage. Richard, let me get your thoughts on this. I mean, these are demands that are pretty well impossible to reconcile, aren't they? I mean, they're just maximalist negotiations. And I'm wondering what you make also of Trump saying the US Navy now has 100% control of the Strait of Hormuz. It looks like no one has control of it at the moment.
Well, it's just a load of hot air, isn't it? It's Trump maxing because he was upset that the Iranians came up with some equally impossible negotiating rules. So he's just firing them back. So I don't think we need to sort of worry too much about it. You know, markets are interested in change and no change there. Yeah, Trump's right. They do have 100% control of the strait because they have a blockade at one end. And the Iranians have 100% control of the strait because they can just threaten to attack vessels that come through. That's not exactly true with either of them because there are still some shadow tankers coming through. You know, quite a few reports of ships passing in the night with their transponders off. So there is some leakage there. And there's also talk of some shuttling, you know, through to from the Gulf through the land route, and also of smaller tankers coming through and offloading. So there is some leakage, but fundamentally the strait is closed. I mean, I looked at it the other day, and there was one tanker with its lights on going through, which you can see from marine traffic. Nearly everything that's going through is obviously going to have their electronic conspicuity switched off. So really, there's no change as we've seen probably for the last couple of months.
Yeah. Sunil, what are your thoughts on this from maybe a market perspective here? Because the oil markets have sort of been pricing in a resolution to this. They've obviously been moving up and down depending upon Trump's comments and Iran's comments. But I'm wondering if there's going to have to be a change soon. Are traders now going to have to price in maybe a prolonged closure and much bigger disruption than we've experienced in the past?
Yeah, I think in the first half of this year, there was a bias towards optimism, and some of that is changing now. Both on the AI trade, which we'll talk about, but also on the energy trade. I think people are beginning to realize that the initially, when people are thinking about the worst possible situation in February, that hasn't happened. But there now is a realization that supplies are going to be affected over a long term. And what happened was that a lot of steps were taken to buffer against the immediate shortfall of supply. Now it's becoming apparent that the situation is going to carry on for several months, if not years. And so expectations need to be readjusted, and calculations of the actual equilibrium price needs to be adjusted. And so that's why you're seeing the Brent crude price go up slowly. So I think there's no doubt that the situation is going to result in higher oil prices for a longer period of time.
So markets have got to price in then higher yields as well on bonds, because that's going to drive up inflation expectations. And at some point, you presume that if oil really does remain maybe above $100 for a sustained period of time and bond yields remain elevated, that's going to hit stocks.
That's right. And I think that's what I mean by a change in mood, is that you can see generally the desperate steps being taken with the U.S. intervention in the yen, with Trump trying to talk up the Iran talks, and also with Nvidia trying to show that they have enough financing, like they did a couple of days ago, just trying to allay fears about the future. So I think it's a sign that there are real concerns, and there's a lot of damage control that's being done in advance.
Richard, should we be worried that maybe some of the buffers that stopped oil shooting up earlier on in the crisis are now slowly being eroded? First of all, storage capacity or reserves are being eaten into at quite a high rate now, and China has also started importing crude oil again. It had stopped, and that had been a big difference, hadn't it, to oil prices, and help keep them lower. We've also got a lot of damage now going on to Russian refineries because of the Ukraine war. They're now having to import refined products. Is this going to be a significant change so that maybe we won't be as lucky this time as we've been earlier in the conflict, and oil is going to have to react much more aggressively?
Well, I think in general, there's a lot of oil around. It's just in the wrong places, and that causes price hikes as much as if there were genuine shortages. One of the key areas does seem to be in product. We've seen fuel prices for diesel, for instance, go up significantly more than, say, the oil prices. And diesel is very important because it's used as a major input in industry, into farms, into logistics. All of these things are pretty important, and its lack of refinery capacity is probably one of the key issues. And it's not surprising that the Ukrainians have been attacking Russian refinery capacity, because that is a bottleneck. But I think we need to look broader than just oil in terms of the fact that clearly inflation is the bias is to the upside and getting quite strongly to the upside. I've just been running through some charts this morning, and there's almost no indicator that you can look at where inflation is not going up. In fact, the only surprise is it's not necessarily higher. But then when you have organizations like the Fed looking at various different types of inflation measures that take out things that people actually spend their money on, like housing and energy and food, the rest of us have to buy that stuff. So it's quite fine for the Fed to take out the things that actually are going up, but that doesn't mean to say that it makes the inflation picture look any better. To my mind, the bond market is looking fragile, and that could be, if there is ever going to be a trigger for markets to come off, it'll happen there.
Well, Sunil, you mentioned that point a little bit earlier on. Presumably, if bond yields go and breach their year highs, they're pretty close to them now, aren't they, in the US? The 10-year, the 30-year yield, both very close to 2026 highs. They could go back above that. That is going to have an impact on stocks. I mean, one of the things we're seeing is all of this financing that's going on for the hyperscalers, semiconductor companies, the AI-related stocks, not least NVIDIA, lining up $500 billion to invest, and it's sort of got a sort of a rather unique way of doing it. It's basically lending to its customers so that customers can go and buy its products. I mean, this is a sort of circular financing, isn't it?
Well, let me give you an analogy. We've seen this in China, right? So in China, we saw people selling overpriced houses financed by banks and selling it on credit. So what you have is NVIDIA, which is selling a product which costs them $2, selling it for 10, and then financing the customers to buy it at 10, as long as they pay $10. And so I think you have a situation where they are, and you're seeing that they're getting jittery about it. The fact that they now need to prove the fact that they have financing and that this risk is spread out across different counterparties, I think is an indication. Also, the fact that the CDS spreads, the credit default swap spreads on NVIDIA went up to 82 basis points last week. And so all of that is an indication that people are concerned, and there's a lot of steps being taken to try and get ahead of it. And LA fears, but the fact is that what they're doing is basically spreading the risks across different counterparties. You still have a situation that a lot of money is being spent, and it's not very clear that the market would be able to sustain higher prices 3 years, 5 years in the future to justify repayment of these loans. I think that's the uncertainty.
I mean, Richard, I'm interested in your thoughts on this. I mean, we've seen time and time again in the markets, haven't we? When you think you found a new way of doing things, it ends up coming back and biting you. And here we have again now, people thinking that we've got a new way of basically financing tech. Tech is no longer a depreciating asset on your balance sheet anymore that you've got to write down. Jensen Huang's now saying it's an investable asset, and its chips are basically investable assets as well, and that changes how you raise money and how you finance their enormous spending. I mean, what do you say to that?
Well, all of this is quite right. A mortgage is a leveraged asset, but it's actually a security for somebody else, depending on payments. And as Sunil was saying, you've got to hope you've got to get the money back. But we're talking now about the sheer massive weight of money, and we're looking this financing. One announcement, $500 billion. Now, when I was a boy, 1 billion was a lot of money. We're now looking at one deal, one day, $500 billion. And we talk about spreading risk. What happens is everybody takes a share of the risk, but they're now taking so much of it that it's getting ridiculous. I mean, I know on your show, you've talked about figures of these of this financing as high as 2.4 trillion. This doesn't include the NVIDIA $500 billion. I mean, it soon adds up to real money. On top of that, Trump is increasing the US budget deficit by 2 trillion a year. That's on a budget deficit of sort of 39. It's quite a big percentage. And then with this big, beautiful bill, he's giving money back to the average American. It's hardly surprising the markets are going up because this money can't go into data centers immediately. You can't buy enough concrete and steel and all the rest of it. So it ends up in the market. So we are in this very, I'm going to call it a cappuccino market. You heard it here first, because we've got a little bit of real stuff at the bottom and a huge amount of froth on the top. And we're really going back to 2008 era, 2000 era. 2000 era was obviously the dot-com bubble, and now we're combining it with a liquidity bubble. And I think the inevitability is still there. And as I said a moment ago, you have to look for a trigger because with this much liquidity, it's all built on confidence. So what's going to knock confidence? Well, The most likely thing is some sort of crisis in the bond market, but it takes time for that sort of thing to develop because we're talking about bankruptcies. And, was it Hemingway who had a character who said, you go bankrupt slowly and then you go bankrupt very, very fast.
Yeah. Yeah. I mean, it's Sunil. I mean, Richard mentioned, you have mortgages on houses. So that's in effect borrowing against property. But here, this is like a mortgage on semiconductors. You're borrowing against chips. I mean, it's
exactly. And what you're doing is you're basically financing the asset without really having visibility about the cash flows coming back to pay for the asset, right? So that's where my concern is. It's not very different from subprime. When you're selling something to somebody saying, okay, I'm financing a house which is worth $500,000. I've got the asset. I don't know whether the person can actually pay me back, but I've got the asset which is so valuable. And then what happens? What happens is there's over lending. The asset prices fall, okay, and then suddenly you find that the person who was supposed to pay you back doesn't have the cash flow. So I think this is a concern, and layered on top of it is the fact that the value of that asset is not dependent upon NVIDIA itself. It's dependent upon what other similar assets are going to be worth around the world. And you've got many people working on chips now, right? And many people working on AI. So to expect that you can maintain current asset price levels of your chips 2 or 3 years in the future, I think is very risky issue. It's exactly like a subprime 2006 lending, where everyone believed that this asset is going to be worth what it is. It's going to continue to increase like it's increased in the last few years, and therefore we can lend against it, and everything's going to be fine.
And you often find, don't you, that if it does go wrong and you want to claim against that asset, you go and find that many other people have the same claims against exactly the same asset, and you can't get back what you thought was secured.
You don't find a buyer. You don't find a buyer for that asset suddenly, right? That's the problem.
That's only part of the situation. If you add in the whole derivative market, where, for instance, you've got one share, but many derivatives written against that share, you've got this huge pyramid of what essentially is debt built on the top of one piece of assets. So you don't even have to have multiple lenders looking at that. People are writing futures and options against these assets as well, and that's also exaggerating the influence. So the thing is, if you go back to 2008, everyone was bankrupt. Because you had counterparties who were all shared the risk, but the risk was just too high for the market to take. And fortunately, the US Treasury came through there and managed to bail the markets out. But you do wonder the quality of the people now in these high places, if they're actually able to do the same again. And the picture looks pretty grim.
They don't have the firepower this time around, do they, to go and bail out people? They're already maxed up.
Well, the firepower is one thing, but it's also the quality of the people. People like Hank Paulson, who did a fantastic job as Secretary of Treasury. He had an address book that was probably one of the best in the world, from Chinese leaders to junior senators. And he could call on people and call up favors or do deals and that sort of thing. These guys now, most of them are Fox News hosts. They haven't got an address book that's worth 2 pennies.
Sunil, are we missing something? I mean, we've been in the markets a long time. We're always rather suspicious of things like this. But here you have, big companies like BlackRock, Blackstone, Goldman Sachs, KKR, all joining in with these new financing platforms that allow these hyperscalers to borrow against NVIDIA hardware and against data center projects. I mean, you presume there are smart people, smart investment bankers at these firms. So they must think it's okay. Are we missing something here?
I don't know what the small print is, but knowing the organizations you mentioned, I really do suspect that a lot of them are getting very high upfront fees for creating this situation and giving comfort to people. And so what they're locking in is the upfront fees, and the financing, I'm sure, is going to be locking in terms of every single security that they can get. And frankly, if it's dispersed across so many different organizations, so many different uh, um, layers of the capital structure, then it'll be fine. But the fact is that if you saw the interviews, a lot of it is also wrapped up into nationalism, saying we've got to do this for America or else China will take us over. So that all of that seems to, it does concern me. It's because you had a similar situation even when they had the nuclear race, right? Everyone was trying to create nuclear bombs, without understanding how they're going to use them, what they're going to do with them. And they had this race that we have to get it first. We have to get it first. People are spending money getting it first. And then when they had them, you have them and you now don't do anything with them, right? And so I think, I'm concerned that this discussion is becoming like that. If you listen to anybody talking about AI on US media, you will hear the word China at least 10 times, right? And so it's turned into a battle. It's almost like, we've got to do it first. And so I think that's, for me, like you said, we're pessimistic ex-bankers. That's things of somebody trying to divert attention from the real fact that this is a financing transaction, not a political battle.
Yeah.
Well, the irony too is that the strategic space that all these chips sit in with China and with the US is somewhat different. The US is going for very much the leading edge stuff and the high compute stuff. But how often do you need that? What the future will bring in the next few years is robotics, where you need relatively lower level chips, where you probably need a higher level of AI software to actually program those chips. And China's in an ideal position to attack that more commercial market. I've no doubt that the leading edge strategy of the US is actually a good one. The danger is that they're putting in 10 times more money than they really should be at this stage of the development.
And it relies on them having... Sorry, carry on, Sunil. Well, it relies on them having premium customers, doesn't it, who are prepared to pay high prices. And if you've got Chinese models that are not far off the same sort of level, same sort of speed, but maybe 10% of the price, you probably should go for those models.
And also directed much more commercially towards robotics and automation.
Yeah, to actually usage, right? Effect. So, I mean, it's not a good analogy, but if I can permit me to talk about this, is that you look at missiles, right? The US has these expensive billion-dollar missiles, and what happens is you have a $5,000 drone which is able to combat that.
Yep.
So what matters is the effect of the technology that you bring in, rather than how good it looks and how great it is. It's the actual usage. And I think the Chinese have been very good we've seen this across all products, manufacturing products, how Chinese are very good at reducing the cost of a product while not impacting the benefit for the user.
Yeah.
Right?
Yeah.
And I think that's something that you can see. I think I saw some report yesterday that 43% of the tokens purchased by wholesale users of AI are Chinese tokens. 43%. Right?
Wow.
So these are
There's also
used by developers, etc. No, developers. These are developers. That means the volume of tokens used by developers for AI uses, 43% are Chinese tokens. So what's happening is when you're building an AI product, you need AI technology behind it. And what you're doing is you're buying the Chinese tokens rather than the expensive tokens from OpenAI, etc. And because it works just as well for you, for that specific need that you need, if you're making an agent or whatever. And so you have these super expensive models which are not necessarily required by everybody.
Yeah.
And what has happened is, as people have shifted, the reaction from OpenAI and other people has been to reduce the cost of their tokens. Okay, so
Yeah.
this is what we're talking about. The value of the cash flows coming out of that asset that is being sold is reducing,
Yeah.
and I think that's where that's where the concern comes from.
But there is a different market space. There will be a market for those high level, high value
Sure.
AI, in terms of pharmaceutical development, or
Medical.
leading
Yeah,
edge
yeah,
things there. So
yeah, yeah.
so that's why I say the AI is in slightly different spaces in the two markets. And going back to your comment earlier about the US being afraid of China having the jump on them, they are in slightly different areas. The question is whether each side can make the economics work for them.
Yeah. Well, look, it's not just companies, it's whole economies that are really reliant now on this AI boom. To wits of that, we had Singapore's revising up its full-year growth outlook. Its economy expanded 5.9% in the second quarter, powered by a global surge in artificial investments. The Ministry of Trade and Industry now expects 2026 GDP growth of 4.5% to 5.5%, and the AI boom has been a central pillar of Singapore's growth story. The US hyperscalers like Google, Amazon, Microsoft and Meta have committed more than $1.1 trillion to data centers and advanced chip investments since 2023 in Singapore. I mean, Richard, this is great for Singapore, of course, but it leaves it very heavily reliant, doesn't it, on one single piece of the economy.
Well, I don't know where they're going to put data centers. These are quite big things, and Singapore's quite a small place. So that's interesting. But I think Singapore is obviously in a real hotspot. It is a real trading hub. It's like another Strait of Hormuz, but an open one, and one where the free market is very happy to trade. So clearly that's been an important area. It obviously it is a very high knowledge center, very important financial center, very important booking center. So and it is regarded, I think, now globally as being, a true independent global hub. Hong Kong, of course, is, I'm biased, of course, but it'll still always be bigger and better. But we're regarded much more as a gateway to China. But Singapore, I think, is in really quite a good position to develop its economy in this sort of way. I'm slightly less confident about the hardware side, but certainly in terms of the software and the soft skill side, I'd be very positive.
Sunil, if AI investment were to retrench sharply, presumably we would see signs of stress in places like Singapore, not just Singapore, maybe South Korea, Taiwan as well. But, for now, the economy remains pretty resilient to all sorts of global geopolitical problems because of this AI cycle.
Yeah, I think Singapore, is a very small economy, and there are certain industries like finance, electronics, technology, and biomed, which are quite big as a part of the overall economy. And so, what happens is, like Richard mentioned, it is a global hub for some of these things, and given the amount of money that's being spent in AI, even a fraction of that, if it gets downstream into Singapore, it can affect the economy quite a lot up and down. And so you've seen these fluctuations with Singapore sometimes in terms of trade or in terms of energy. When you have any macro impact around the world, it affects Singapore's GDP quite a lot, so they can swing from -5 to +5 quite easily. So I think that's what I would say, is that you shouldn't read too much into one quarter of GDP in Singapore. It does tend to fluctuate quite a lot.
All right. Well, look, thank you very much for that. Very interesting discussion there. You heard Sunil Kashyap, who is Director of Finmet, and Richard Harris, Chief Executive Officer at Port Shelter Investment Management. It's time now for our regular view from Japan, and I'm joined this morning by John Beirne, who is Principal Economist at the Asian Development Bank. Good morning, John.
Good morning, Peter. How are you?
I'm very well, thank you. And now, since we last spoke, we've seen this historic US-Japan yen buying operation, the first time in several decades, actually, that they've combined together to go and intervene in the markets. Things have settled down a bit, haven't they, since that intervention at the end of last month? But the yen has now given back about half of the gains it made there. So do you think this is working?
Well, I think so. Just before the intervention, the yen was at a level of around 164. So this is clearly a concern from the Japanese side as well as from the US side, I would say. And the coordinated intervention ultimately did have some short-term impact. We saw an appreciation of the yen thereafter to around 155. But as you said, it has weakened since then. And I think, with these types of interventions, even the one that we had, the coordinated US-Japan one, I think, the fundamentals remain unchanged. So I think, the intervention has been helpful in terms of breaking momentum and providing some short-term respite. But ultimately, given that the fundamentals remain unchanged, we have seen this slide back towards, I think, currently around the 160 level. So certainly it's not something sustainable, I would say.
I'm wondering why the authorities think this 160 level is so important. I mean, we've heard the Japanese authorities say that they don't want a disorderly slide in the yen, but it hasn't really been disorderly, has it? Hasn't been this sudden dramatic collapse. It's been gently weakening sort of all year. Scott Bessent says it's undervalued, but I don't know why he knows better than the markets as to whether or not a particular currency is undervalued or not. And you could argue that there are some very good reasons as to why the yen is weak at the moment. So why is it so important to try and defend this level of 160?
Yeah, well, I think, if we look at the last few months, even further back than that, the yen has been depreciating quite consistently. And, when it reached the 164 level, I think, that was a real concern. This is having significant impacts on the domestic economy in terms of inflation, in terms of consumer sentiment, in terms of spending in the economy. We saw household spending coming down more recently, but the recent data, I think, was for June. And this was unexpected, given that, there has been continuous government support to basically mitigate the impacts of the inflation. There has been rises in real wages from the recent data as well. So I think, continued depreciation of the yen puts additional pressure on the authorities to mitigate these inflationary impacts. And it basically just looked like the 164 would carry on towards even the 170 level. So in terms of why 160, it's always difficult to put a number on where the threshold of pain lies. But I think clearly that seems to be some sort of a psychological level that is uncomfortable for the Bank of Japan and the Japanese authorities. And, in this case, I think it was particularly notable that the US came in. There are concerns that a significant intervention from the Japanese side would affect the cost of borrowing in the US if large amounts of US treasuries were used to take care of that intervention, so to say. So that's a real concern on the US side. And also, it was notable that the intervention on the US used euros, of course, rather than dollars. Also pointing towards this concern around the borrowing costs on the US side.
Well, look, there's several things there. The first thing you mentioned, that obviously this is having an impact on inflation and driving inflation higher. But then isn't the missing link here the Bank of Japan? It's all very well the US Treasury joining forces with Japan's Ministry of Finance to go and intervene in the market, but the Bank of Japan's doing nothing at the moment. It needs to raise interest rates, doesn't it, in collaboration with those authorities if it really wants to support the yen.
Exactly. I think, when we talk about how to appreciate the yen in a more sustainable way, it needs to come along with rises in interest rates. And, by all estimations that I've seen, at least, current rates in Japan are still below what one would regard as a neutral rate of interest, which can be up to around 1.5%. So still significantly below that at 1%. I think that the tricky thing for the Bank of Japan at the moment is on the outlook for the economy, number one. So, raising rates at this particular time could hamper the growth outlook, could, the growth outlook is already very fragile. So increasing rates may affect that. And the second thing is that on the fiscal side. So Japan has, as you know, a very high level of debt to GDP, over 200%. So rising interest rates would have significant fiscal implications. And on top of the fiscal risks that are already there, this could be something that could sort of paradoxically lead to depreciating pressure on the yen. So I think it's a very tricky situation at the moment. But, if we look at the recent signals coming out of the Bank of Japan, these are very hawkish comments in terms of expectations on rates. We may even expect a rate increase in September, certainly by the end of the year. But that said, the fundamentals are not likely to really move the needle significantly in terms of the yen. So, we still expect Fed rate rises as well. So that the interest rate spread is probably going to not move too much for the rest of the year. So it's very difficult for the yen at the moment.
Well, this is the thing. We had this summary of opinions from the July meeting released on Monday. Several board members were arguing there that underlying inflation is close to 2%. Some were saying that it's moving even higher. There's risk of an overshoot. We had several members of the board talking about a shift towards monetary tightening. I mean, it's prepared the ground, hasn't it? It really has to raise rates in September. Otherwise, it's going to risk the yen sliding more. And even then, it could raise rates 25 basis points only to find that the Fed does the same thing.
Exactly. I think, on the cards, certainly a rate rise. Recent comments even point towards that taking place in September. But as you said, raising rates maybe just to stabilize the yen rather than appreciate it, because subsequent rate rises are also expected on the US side. So this rate differential between Japan and the US would remain unchanged as a result of that. So it would take sort of a more aggressive tightening on the Bank of Japan side, or equally some easing perhaps in the future on the US side to really address the fundamentals and leads to a sort of sustained appreciation of the yen back to where it has been, a few years ago, perhaps. Although I don't expect it to get to that level, potentially ever, in fact.
Well, what about the Japanese government? There's the other aspect here, isn't it? That it wants to borrow a lot of money to finance tax cuts. Fiscal policy is not really working with either the Bank of Japan or the authorities who are trying to support the yen at the moment. Has there got to be some reconsideration of Japan's fiscal stance?
Yes, well, I think that the fiscal stimulus package, there's a lot of uncertainty around how this can be financed. I think if we look at, for example, the consumption tax, which is proposed to be reduced to 1% from 8% from April of next year, this will entail a significant revenue loss for the government, and it remains unclear how that shortfall would be made up, as indeed it would, finance the rest of the package. And this all points towards additional fiscal risks. And I think, the plan, I suppose, is to realize the growth impacts of this fiscal stimulus package before the short-term, costs would be kicking in. But I think it's certainly a risk in markets, and it's something that's adding to the concerns that we're seeing in the currency market at the moment in Japan.
And what do you make of the Bank of Japan's current account surplus? No longer a surplus, it's turned negative, hasn't it, for the first time in 17 months? This is presumably because imports are now, the cost of imports, particularly crude oil purchases, are being made higher by the weaker yen.
Yes, that's one side of it. I think Obviously the oil price has led to significant increases in the cost of imports. Japan imports, 90, the vast majority of its energy from outside the country. So this is obviously having an impact on the import bill. Another factor on the financial account, I think there has been a sharp increase in dividend payments to foreign investors by Japanese firms, particularly around investment in AI. So this has been another factor which has affected the overall current account with the recent data. But I think, yes, certainly, the longer this Middle East conflict would carry on, the further the pressure will be on the current account from the import side. And we've seen, recently that the oil price is picking up again because of escalated tensions in that part of the world.
So where do we go from here? You can't help but think the markets are going to test the resolve of the US Treasury and the Japan's Ministry of Finance at some point. The yen will slide. Presumably, if they want to try and intervene again, it's going to be a little more difficult. They can't sell euros again because that's caused problems with the European Central Bank. So they're going to have to sell dollars, and that means Japan may need to sell some Treasury bonds to finance that, because the borrowing facility that it's been using, this $60 billion borrowing facility at the Fed, just isn't big enough. So are there risks now for the US economy as well going forward?
Certainly there are risks. I think if we look at the yen at the moment at the 160 level, as you said, and the outlook for the yen is really, a lot of depreciating pressure there. So I think as things stand, we can expect to see a shift back towards where it was before the intervention, towards a 165 level, which would trigger some intervention. But I think, in comparison to the previous intervention, I think we're likely to see further hawkish comments coming out of the Bank of Japan, which may help to support the intervention. So if intervention would come along with firm comments on monetary policy, and even, an actual interest rate rise, should it be in September, then this may help to provide some more sustainability to the level of the yen as a result of that. But I think selling treasuries, as you said, will become inevitable, and this will be something of concern to the US side as well, certainly.
Yeah. It makes you think, really, 25 basis point rate hike from the Bank of Japan, it's just not going to be enough, is it? Really, if they want to turn this around, they've got to raise rates quite substantially and quite quickly in order to try and close that gap with US rates, and then get the unwind of the carry trade, which will then start to build momentum behind the yen as people unwind and as assets move back to Japan. But I presume the Bank of Japan's, given what we've seen in the past, is going to be very reluctant to act too aggressively.
Well, yes. I think if we look back to, I think it was August 2024, when we had this unwinding of the carry trade, there was a sharp increase in rates by the Bank of Japan. But I think at that time, there are other developments at play as well. I think weak data came out of the US, which helped to narrow the spread somewhat. There was also a lot of volatility in equity markets around AI. So a number of factors were at play then. I don't think we're at that type of situation, or we're looking at that type of situation at the moment. Also, the Bank of Japan has learned from that episode to improve its communication on monetary policy. But, I think certainly there would have to be a compression in this yield spread between Japan and the US for the yen to have some sustainable appreciation beyond what we would see with just intervention alone. It would have to be carefully communicated. But, at the same time, over communication can lead to, rate changes being priced in and therefore having no real impact on the exchange rate. So I think it's very difficult at the moment. And yeah, I think intervention combined with some form of rate change will be key, I think, to strengthen the yen, being balanced against the other risks that we mentioned around the economy and the fiscal side as well.
I mean, what's clear is that this is not just a Japan issue, is it? This is actually an issue for the global economy and global markets, because in order to try and halt the slide in the yen, it's going to have an impact potentially on US bond yields at a time when they're already elevated. It's going to have an impact on the carry trade. It's going to have an impact on maybe pension funds, life insurance companies moving assets back to Japan, which is going to have a big impact on global capital flows. There are a lot of global implications for this. It's not just a Japan issue.
Yeah, certainly. I think, we would likely see significant volatility in global capital flows, and particularly this will be a concern for emerging markets, which may incur significant capital outflows, which would affect their currencies, of course, and lead to additional inflationary concerns on top of what we're seeing at the moment. And I think, the timing of this would be obviously not optimal given the inflationary pressure that's already there from oil prices, from conflict in the Middle East, for example. So I think, this would certainly have disruption to markets at a time when it's already elevated, I would say.
That's John Beirne, who is Principal Economist at the Asian Development Bank.
You're listening to Peter Lewis's Money Talk. Money Talk.
Thank you for listening this morning and for supporting independent broadcasting in Hong Kong. Please help by subscribing to my daily Asian newsletter. It's completely free of charge, and that's where you'll find more information on some of the topics we've been talking about today. It's at peterlewismoneytalk.substack.com. I'll be back tomorrow when I'll be joined by Andrew Ferris, the CEO of Economist Advisory, and Sam Faver, CEO at Mandarin Capital. Providing a view from mainland China is Hao Hong, Managing Partner and CIO at Lotus Asset Management. Have a great day.
Money Talk.